Today, January 29, 2026, all eyes on Wall Street are on Mastercard. The anticipation is palpable, with investors, analysts, and even everyday consumers waiting to see what the company will reveal. Mastercard is a giant in the world of payments, and its performance often signals broader trends in the economy. Before the market opens, Mastercard will reveal its earnings report, a financial report card showing how much it made, spent, and profited in the last quarter. This isn't just a routine update. It's a moment that can set the tone for the entire financial sector. Investors pore over these numbers, looking for clues about the company's health and future prospects. These reports can send a stock soaring or tumbling in minutes. A single line in the report, a surprising profit, or an unexpected expense can trigger massive reactions. The stakes are high, and the market's response can be swift and dramatic. Why should you care? Because understanding these numbers gives you insight into the economy, consumer habits, and your own investments. Mastercard's results reflect how people are spending, how businesses are growing, and how confident consumers feel about the future. If you're invested in the market, or even just curious about where things are headed, these reports matter. This isn't just about numbers. It's about the story they tell. Is Mastercard growing? Facing challenges? Are its leaders confident? The earnings call is a chance to hear directly from the company's top executives to get a sense of their vision and strategy for the months ahead. Earnings season isn't something to fear. It's a chance to check the health of your investments, like a doctor's checkup for your portfolio. Just as you'd want to know if your health was changing, you should want to know if your investments are on track or need attention. Today's Mastercard announcement is one of those critical checkups. It's a moment to pause, reflect, and decide if your investment strategy still makes sense in light of new information. The big question: will Mastercard deliver good news or bad? And what should you do about it? The answer could affect not just Mastercard's stock, but the entire financial sector, and even your own financial plans. Some see recent weakness in the stock as a warning, others as a buying opportunity. But you need to do your homework first. Don't just follow the crowd. Take the time to understand what's really happening behind the headlines. Let's break down what's happening with Mastercard, what the experts are saying, and what you need to know to make smart decisions. Whether you're a seasoned investor or just starting out, understanding these moments can help you navigate the market with more confidence and clarity. You probably have a Mastercard in your wallet, or maybe you've used one to shop online, book a flight, or grab your morning coffee. The iconic red and yellow circles are everywhere, from local stores to international airports. But do you know what the company actually does? Most people think of Mastercard as just a credit card, but the reality is much bigger and more interesting. Mastercard isn't a bank. It doesn't lend money, set your credit limit, or even issue cards directly. That's your bank's job. Instead, Mastercard works behind the scenes, connecting banks, merchants, and consumers all over the world. Think of Mastercard as a payment technology company, the high-speed toll collector on the global money highway. Its network is the invisible infrastructure that makes digital payments possible, whether you're buying groceries in New York or souvenirs in Tokyo. Every time you tap, swipe, or enter your card details online, Mastercard's network springs into action. It verifies your identity, checks your balance, and ensures the merchant gets paid, all in a split second, with layers of security protecting every step. For this service, Mastercard takes a tiny fee from every transaction. It might seem small, but when you multiply that by billions of transactions and trillions of dollars moving through its network each year, the profits add up fast. Unlike banks, Mastercard doesn't take on credit risk or worry about customers defaulting. It simply facilitates payments and collects its fee, no matter who wins or loses in the lending game. This toll road business model means Mastercard profits as the world moves from cash to digital payments. The more people tap, swipe, or click to pay, the more Mastercard earns, no matter the economic climate. And it's not just a credit card company, it's a tech powerhouse at the very center of global commerce, processing payments in over 200 countries and territories, and constantly innovating to keep transactions fast and secure. Its massive, trusted network is nearly impossible to replicate, giving it a huge competitive advantage. A moat, as Warren Buffett would say. This moat protects Mastercard from new competitors and helps it maintain its leadership. Understanding this unique business model is the first step before analyzing Mastercard's earnings, evaluating its growth potential, or considering it for your investment portfolio. Let's talk numbers. Analysts have already set the bar for Mastercard's Q4 earnings. They predict earnings per share, EPS, of $3.67, a key measure of profitability. The higher the EPS, the more profitable the company. On revenue, the consensus is $7.28 billion, reflecting all those tiny fees from global transactions. Strong revenue means people were spending, and Mastercard's network was busy during the holiday season. Here's the twist. Most analysts think Mastercard won't just meet these expectations, it'll beat them. An earnings beat usually sends the stock higher, signaling the business is even stronger than expected. The stage is set for a potentially positive announcement. Expectations are high, but Mastercard is seen as strong enough to clear the bar. Let's see if the company delivers. Some Wall Street voices carry extra weight, like Jefferies, a major research firm. Jefferies recently reiterated its buy rating on Mastercard, setting a price target of $540 per share. That's a strong vote of confidence in Mastercard's future. Their advice: if Mastercard's stock dips, especially on regulatory worries, see it as a buying opportunity. The market often overreacts to bad news, pushing prices down temporarily. Jefferies believes Mastercard's business model and growth prospects are so strong that short-term dips are just noise. They're looking past the daily market swings to the bigger picture. In their view, Mastercard's long-term trajectory is still up. That's why they're telling investors, don't panic, think long-term. No company is risk-free, and for Mastercard, the Durbin-Hawksley bill is a looming threat that could reshape the way it does business in the United States. While Mastercard has long enjoyed a dominant position in the payments industry, new legislation can quickly change the landscape, introducing uncertainty for even the most established players. This proposed U.S. law aims to increase competition in credit card processing, letting merchants choose cheaper networks for transactions. The bill is designed to break up the current duopoly held by Mastercard and Visa, giving smaller networks a chance to compete and potentially lowering costs for businesses and consumers alike. Right now, Mastercard transactions run exclusively on Mastercard's own network, which means the company controls the flow and fees of every swipe, tap, or online purchase made with its cards. The bill would force big banks' cards to be compatible with at least two networks, opening the door for alternative processors to handle transactions that would have previously gone through Mastercard. Merchants could then route transactions away from Mastercard, opting for networks that offer lower fees or better terms, which could significantly cut into Mastercard's revenue stream. Mastercard's business model relies on collecting a fee for every transaction on its network. Less traffic means less revenue. If merchants start choosing other networks, Mastercard could see a noticeable dip in its transaction volume. Analysts estimate this bill could reduce Mastercard's revenue by 1 to 2%. While that percentage might seem modest, it represents a significant impact when applied to the company's massive annual earnings. That might sound small, but for a giant like Mastercard, it's hundreds of millions of dollars. Money that could have been reinvested in technology, security, or shareholder returns. This is why some investors are nervous. Regulation is a real risk, and the financial markets tend to react strongly to any sign of potential disruption in a company's core business. The threat can't be ignored, especially since the U.S. is Mastercard's most profitable market, accounting for a large share of its global revenue and growth. For investors, understanding the implications of the Durbin-Hawksley bill is crucial. It's a risk every investor needs to watch closely, as regulatory changes can have long-lasting effects on even the strongest companies. So, if the Durbin-Hawksley bill is such a risk, why are analysts still bullish? First, the bill isn't law yet. Legislation can take years, and often gets watered down or defeated. Analysts see the 1 to 2% revenue hit as a possibility, not a certainty. More importantly, Mastercard's global growth story is much bigger than this one U.S. risk. The company is expanding rapidly in Europe, Asia, and beyond, riding the global shift to digital payments. Even if U.S. growth slows, international gains could more than offset it. Mastercard's brand, technology, and relationships create a moat that's hard to breach. Many merchants may stick with Mastercard for its reliability and security. Analysts believe Mastercard's strengths and innovation will keep it growing, even with regulatory bumps. Mastercard's success depends on one thing: consumer spending. When people feel confident, they spend, and every transaction fuels Mastercard's revenue. Despite inflation and economic worries, consumer spending has stayed strong, especially during the holiday season. This resilience is a great sign for Mastercard's business. Strong retail sales and low unemployment mean more transactions and higher revenue. That's why analysts are optimistic about Mastercard beating its Q4 estimates. But if consumer spending slows, that's a red flag for Mastercard's future growth. For now, the trend is positive, but it's a key metric to watch. Let's put it all together. Mastercard is a dominant company with a powerful business model, a trusted brand, and strong consumer spending trends. Analysts expect it to beat earnings and see long-term growth as digital payments expand. The main risk is U.S. regulation, which could shave 1 to 2% off revenue. There's also the risk of a global recession hurting consumer spending. But analysts believe Mastercard's strengths far outweigh these risks. The company's global opportunity and resilient business model make it a compelling long-term story. The positives, for now, outweigh the negatives. So, should you buy Mastercard stock if the price dips? Only you can decide, but make sure you're acting from knowledge, not fear. Mastercard is a financially sound leader in a growing industry, with analysts seeing upside and strong consumer trends. But you must be honest about the risks: regulation, economic downturns, and market volatility. Only invest if you have a long-term horizon and a strong financial foundation. No credit card debt, a solid emergency fund, and retirement savings. If you check those boxes and believe in the digital payment revolution, Mastercard could be a smart addition to your portfolio. But always do your own research and trust your judgment. Be strong, be smart, and be secure. The decision is yours. Make it wisely.